Hi, everyone. Welcome to another KE Report webinar. In this webinar, we are featuring Elemental Royalties, traded on the TSX Venture Exchange under the symbol ELE and on the OTCQX under the symbol ELEMF. I am joined by the President and CEO, Frederick Bell. Now, Fred, before we get into this webinar, just give us a little update. What are some of the key points that you really want investors, those either looking at Elemental Royalties, those invested in the royalty space, or already shareholders of Elemental, what do you want them to really take away from this webinar?
Thank you firstly for putting this on, Corey. And I think the most important point that it's really important to get across is that Elemental is a junior royalty company by size, but with a portfolio that is much more akin to one of the majors. We have a very mature portfolio of high quality, long life producing, that is cash flowing royalties, and not only a portfolio currently that paid us $5 million US last year, but is actually doubling that as we go forwards over the next 6 months. So broker consensus about 11 million revenue in 2022. So we have a lot of organic growth in that portfolio as well, and I think that is one of the key points to get across to investors.
Okay, perfect, Fred. So when you can, please fire up the presentation. We're going to walk through the corporate presentation here. I'm going to be interjecting questions as we move through this presentation. We already have a question sent in, so we will get to everything as the presentation more or less dictates. So please keep sending your questions in, and I will take care of those and interject them when needed throughout this presentation. So Fred, let's get going then, please.
Brilliant. Thanks, Corey. And on the basis that everyone can see this is the same presentation that we have on our website. So if anyone would like to access it, you can that way. Important disclaimers on what we're about to cover. I think first one, very briefly, what is a royalty company? And a few really basic principles to take away from it are that, particularly in our case, it's exposure to producing cash flowing assets. It's well diversified by operator and jurisdiction. We have low overheads, given that we're a very small company. We don't have to operate any assets ourselves. And crucially, we have non-dilutive exposure to these assets going forwards in the future. So we have optionality on multiple existing mines, on any discoveries and any future resource additions that they make. And that is really the power of the model.
So the non-dilutive aspect, Fred, just explain that a little bit more to everybody, what that means in terms of you guys not needing to spend any further money.
Yeah, so it's really where you get the most value uplift in a royalty is what they make of that asset in the future. And to give an example, 2 of our assets are genuinely district scale in size. And so Capricorn, which we just bought, Karlawinda, is 150 kilometers with a 10+ year mine life based on reserves just on what they have. But then assets like Wang Yon and Premier Gold, now Equinox's Mercedes, those are 700 square kilometer and 1,000 square kilometer license packages. So these are assets that we expect to be multi-decade mines going into the future. And our royalty will be there at 1%, 2%, whatever it is, irrespective of how much they mine. And so if they dilute shareholders 50% along the way as they build out that mine, we will still have the same royalty over it. And that's the most important principle in the royalty model.
Okay, perfect. Thanks, Fred.
This slide here is really highlighting where a snapshot of what we are today. And this was a startup royalty company in 2017. And we took it through to a listing in 2020 on the TSX.V. We doubled the size of the company twice. We also made our largest acquisition, South 32 royalty portfolio, which kicks in really this quarter and going forwards with a 10+ year reserve life on the main asset. We have a really good track record of not just growth, but also growth per share, adding value for shareholders. Every time we have raised money, we've done it at a higher price. Management board still have material insider ownership, 16%. And I think that it is very rare to get exposure to a royalty company, almost unique in the last decade, to get exposure to a $100 million royalty company with high quality cash flowing assets. And that is exactly what Elemental is today. And, really important, that focus on, I think, quality. And if you look at our timeline, since we started, and most of the history of the company, we've been private. But if you look at what distinguishes us from peers, it is the quality of the asset and the operator. These are not postage stamp sized royalties. These are not royalties on startup $40 million market cap companies. These are, two of the assets have 10-year mine life plus, based just on the reserves. Some of these assets we look at and think in 10, 20, 30 years time, they should have the same mine life that they do today. And that is where you get the power of the royalty model. And I think that's where the most successful royalty companies have really been able to add value. And just looking at this, one aspect I would always take out of it is that people say the royalty space is competitive, and I think it always has been and it always will be. But we have demonstrated from the outset that we have been able to acquire, to find good quality royalties at good value prices. And if we could do that in 2017 when we started up, we can certainly do it today. And we have more access to capital, better team, better connections, some really good quality institutional shareholders behind us to enable us to keep doing that.
Now, Fred, just a little bit more color, because one thing that I think sets Elemental apart, especially in this world where there's a lot more royalty companies right now, is you guys have focused on cash flowing royalties rather than just building a massive portfolio of royalties, say even on exploration companies or exploration projects, but also the long life of these royalties. From my understanding, they're not capped, and a lot of the royalties that you are even cash flowing on now have long mine lives. Can you just give us a general overview of how you've managed and the balance between these two aspects?
Well, it's the holy grail in the royalty space is cash flowing royalties, and that makes it the hardest thing to achieve. And so from the outset, our view was, if we can put a portfolio together of producing cash flowing royalties from day one, we do the hardest part first, and we then have the best foundation to build the company from. And I can tell you, absolute conviction, for every producing royalty we see a dozen, 2 dozen exploration and development royalties. And so our view was, if we can put together 10 million a year plus of US dollars revenue, and we will be there from sort of Q3, Q4 onwards this year, that gives us an ability then to use our own revenue to reinvest in exploration development royalties, but also, and really important feature for us is to get access to credit facilities with the bigger banks. And if we can do that as a $100 million market cap company, there's no one below a 500 million market cap who has that currently. So we'll be a company with access to capital at a better cost than anyone else. We'll have more revenue than any sub $500 million royalty company. And I think that gives us the best platform to then build out that pipeline. And it would be much easier for us to go out and buy exploration development royalties. But this is really building a company that is going to be around for years to come, not months to come. And to do that, doing it the hard way at the beginning, getting these quality long life assets in, that will be the cornerstone for us going forwards. I think that is the best way to add value in the long term.
Okay. It's just one thing that sets Elemental apart, really, is that you guys have a smaller royalty portfolio, but much larger in terms of producing and cash flowing assets. But let's move on.
I'll just skip on that point, really. It's a good segue. I'll skip onto this slide quickly. And every number up on here, which is public, always has been up until 2020, are announced numbers. Our guidance for this year is $7.9 million US dollar revenue, and broker consensus for 2022 on the basis of our existing assets is about 11 million US. So you can see that from last year, we are doubling our revenue going into next year. And that is from royalties we already own. And that is Karlawinda, that had first gold pour on the 30th of June in Australia. And it's Equinox's already operating Mercedes mine, which only has to start paying us a royalty from July next year. And I think that's a growth profile that you can't get in big royalty companies. You can't see $10 billion royalty companies doubling their revenue over the course of a year. And that's something that you can do, when you are our size. And I think it is what sets us apart. There's a long runway of growth ahead of us, but we also have the downside protection of diversified revenue today, which no peer has. And if that's the hardest part for a royalty company to achieve, and we've already got it, I think that is what makes us a really attractive proposition. And it's a reason that we only have 9 royalties, as you said. Is, our view is you put together the best assets, you put them in, and 1 or 2 acquisitions make this a very different chart. And I can remember in 2018, this looked very different. In 2019, this graph looked very different. When we listed in the start of 2020, again, it looked very different. And I think by the end of this year, this chart will again look really different. And if we keep doing that year on year, sometimes it's only 1 or 2 acquisitions, but if they're really good value acquisitions or they're really good quality acquisitions, then they put us in a different place. And that's been the objective for us from the beginning. And I think we sit in a better place today than we ever have. And from a valuation perspective, coincidentally, we're also almost the best price we have been as a public company.
Now, let's talk about that, because there have been a number of questions that have come in. Some people saying that they're very happy with all this growth in terms of income and revenue. However, the share price, especially recently, has been drifting. Now, all royalty companies have been drifting, but what's your strategy then? As income continues or revenue continues to grow, do you think you might pay a dividend at some point? What are some strategies to maybe bring in some more investors so that the share price maybe bucks the trend of the general broader royalty companies right now?
Well, to answer that, I'll go back 1 slide here. And on you can see in 2020, there is a list of what we did over the course of that year, pulling out some of the highlights. And I think some of the catalysts in 2021 are things that are going to really get us valued on the basis of some of the assets we already have. And we mentioned that first gold pour at Karlawinda. So they're currently ramping up the asset in Australia. And I think that over the next month or 2, we should get some good updates out of them on how that's going. But the initial noises are very positive. And that's going to be really material, because that royalty, once it is up and running at commercial rates, is $4 to $4.5 million a year in revenue. And it has a starting 10-year mine life. So that asset is really material for us when you look at what the mine life could be going forwards. And I think when the market sees that come in, that will be a key driver. And I think the second last bullet point there, the option to refinance the debt facility that we currently have with Sprott Lending, I think that in conjunction with Karlawinda is probably the biggest driver. Because at the moment we have a $25 million credit facility we took out with Sprott Lending, and that is at 9 plus 1%. And one of the objectives we had in the second half of this year, in parallel with Karlawinda coming on stream, was refinancing that with some of the bigger Canadian banks. And our view was that we could be halving the cost of the debt through that process. So sort of 4 to 5%. And so if we come out in the second half of this year and we've doubled our revenue on a go-forward basis, we've halved the cost of our credit, our debt, on a go-forward basis, all of a sudden, those are 2 huge de-risking events for us. And it increases our revenue substantially. And one of the really important points when you look at a royalty company is we're at the stage now where every $1 million of revenue we add on, it should be 90% plus free cash flow. And the royalty model is pretty much the only model in the mining space where you can do that. If you're a mine operator and you bring on a new mine, your costs are going up a lot and you're having to operate it. In the royalty model, it's very scalable because every $1 million we're adding in now is coming through. So our margins are improving, our diversification is improving, our access to capital is better, we have more cash flow ourselves. So, it's probably the reason why, and it's public, I bought $30,000 of shares in the market last week. And sometimes there are limited windows in which I can buy shares because we have results starting to come out or we're working on potential acquisitions. But I would certainly continue to be a buyer at this share price. because I know the company very well. I can see where we're going in terms of the assets, but we're trading at a share price that we were, probably almost 12 months ago.
No, there are a couple key points to touch on there. One, you already answered a question that came in that was regarding the restructuring of what somebody called the high interest rate Sprott debt. So sounds like you're working with that. Any more information on what a restructuring could look like, and does the company need a larger debt facility to move forward?
Yeah, so maybe a little bit of context on this one. When we acquired the Wang Yon royalty at the start of 2020, the first bullet point on the top left of this slide, when we acquired that royalty, we actually used an $8.5 million loan from Sprott Lending, and we had it out for 7 months in the end. And after we listed the company, we repaid that loan and kept $1 outstanding. And the reason we kept $1 outstanding was some of the acquisitions we were looking at where we wanted to be able to take advantage of another debt facility as part of the acquisition. And so it's that same effectively facility that we have drawn down on. And it's 9 plus 1% is a cost. There's no cost to refinance it from July onwards. But I think from our position, it enabled us to do a really material transaction. We doubled the size of the company twice in 2020. And a lot of that investment was in growth that we are going to start to see coming in from Q3. And so it's not reflected in the last 6 months, and it hasn't been reflected yet. But really, with Karlawinda coming on stream, that is when it really starts to have an impact. And I think it's underrated, but it's a really important sign of the maturity of the company, is when you can access credit facilities with some of the senior Canadian banks. And typically it's companies much bigger than us. And so I think if we're able to do that in the second half of the year, I think it will probably surprise a number of people in terms of what we have actually been able to do.
Okay, thanks for taking that. And guys, keep on sending in your questions, please. I see a couple more chats coming in. So Fred, let's move on here and we'll take care of some of these questions as well.
So I think just going on here to this slide here, and I think, as mentioned, broker consensus for 2022 is about 11 million US, and one of the questions we've had in the past has been, what are our plans going forwards, both in terms of once we get to that 10 million plus revenue number, and also the credit facility. And I've touched a bit on the credit facility, but in terms of the revenue number, one aspect that we did do in the past as a private company before we listed is we actually paid a dividend, and we did that from the first day we started the company, and it was tied to 5% of royalty revenue. So it never inhibited our plans, but it also meant that we had a focus on returning capital, to shareholders from the outset. And I think every shareholder, maybe one exception, took that dividend in shares, in more shares. But we sounded the market out when we listed last summer. And I think the feedback we got from some of the bigger investors was that at this stage in the company's life cycle, we would do better by growing the size of the portfolio and by reinvesting that capital, particularly when, for example, with Sprott, we're paying 9 plus 1%. There are better ways to spend it. But I think that as we get access to credit at a better rate, and as we have more cash flow coming into the company and able to spend, that starts to be the question around the dividend. That starts to be something that we can look at seriously. Even if it's small at the beginning, it's something that with the mine life on the assets we have, 10 years plus on the cornerstone assets, that looks to be something that we could actually implement from sort of 2022 at some point going forwards in a sustainable manner that doesn't stop us growing the company. And that's always the two key considerations there.
Okay, perfect. So in summary then, no dividend right now, possibly a dividend next year. You are taking that money and reinvesting back in the company though. So there's that balance.
Yes, yeah. And it's always a case of, if we're raising more money to invest it, how much will it cost us to raise that money? And is that going to deliver a better return for shareholders? And it's a bit of a it's a bit of a balancing act, but certainly we are a long way in 2022. If we're $10-11 million of revenue, we're a long way from where we were in 2019 when we were $2.4 million of revenue. So it definitely opens up more possibilities for us. And in terms of the management team and board, the key day-to-day management team, Richard, David, Greg, Megan, Matt, myself, I think. Richard's based in Melbourne, and David, Greg, Megan, myself are in London, and the average age is sort of mid-30s, but we have a really good experienced board around us. And I think, John Robbins is well known with Jim and our advisory panel from Discovery Group in Canada. Probably a dozen companies have sold for 200 million plus over the last decade. And I think that Peter Williams, one of our directors who's better known in Australia, but Peter was at Western Mining with Richard, 20 and 30 years respectively. And I think both of them had a track record in being serially successful. And for us, getting a management team who are really driven, really focused, who have a great track record, in the last decade, there has not been a startup royalty company that has got to $10 million of revenue from a startup position, which is where we'll be in Q3, Q4. So I think we have demonstrated a great track record, but we have a really driven management team who, for us, Elemental is going to be our CV going forwards. We all want to be in the mining industry for the rest of our careers. But around us, we have this really good expertise, track record on the capital markets, on the technical side. I think that's so important. And Martin with finance background on the board, and Simon Collins, who is South32's representative, round off the board. And I think it's an area, the management and board, that we've been able to strengthen as we have built the company, and particularly with the listing. And I think we'll continue to be able to do that with the portfolio that we have, attracting really good caliber people to the company going forwards.
So Fred, one question on the back of this is, with such a small team, how do you go about sourcing royalties? How do you go about finding the ones that catch your attention? And then how do you go about negotiating with such a small team?
So I think that the biggest challenge is using your time effectively. In the first half of this year, partly because we're a public company and we have a larger, higher profile now, we see more deal flow, particularly deal flow that is brought to us, than has ever been the case in the past. And that is, it's a dual-edged sword. It can be an advantage and a disadvantage, because it's very easy to spend all your time reviewing opportunities that you get brought in. But often those aren't always the best opportunities. And I think historically what we have found is the best opportunities are those where we went out and we identified them, and we negotiated them and acquired them directly. And if I go back, let's use this slide as an example with some of our royalties. The royalty, the first one we did on Quale, that came from Acacia, who's part of Barrick now. And that was a non-core royalty that we bought directly from them. Equinox and Austral royalties, those came from Yamana Gold at a time when Yamana didn't know they owned the royalties. The royalty we bought on Endeavour, that was some of our seed shareholders, people who've been in the mining industry for 13 years. They've held the royalty for 13 years, been in the mining industry for much longer. And, the reason they did that deal with us was because they wanted to take equity in the company. And then the South32 deal, which actually had its origins probably going back to 2018 when we first pitched to them as a private company. But none of those opportunities were really brought to us. All of those were opportunities we went out and we found, and we really generated. And I think that's been the biggest focus for us historically. It's been where we've been able to add the most value, and I think it will continue to be where we can add the most value. And alongside those, there will be one or two acquisitions we do that do get brought to us. And that blend of finding the opportunities ourselves, and part of that is using the deal flow that the opportunities were built up over the last 2 or 3 years as a private company. And part of it is, getting in acquisitions that I think, like the South32 acquisition, it really takes us to the next level. It doubles our revenue. It reweights us towards Australia, a tier 1 jurisdiction. It increases our average mine life, the addition of that portfolio. And all of those things combine to then enable us to, as we've mentioned, hopefully access credit facilities with some of the big banks in the second half of this year. And those are achievements that will put us in the strongest position we have been in by a long way. Much stronger than when we listed last summer, and our listing fundraise was at 130 Canadian. It's a completely different company now. I think with better quality of assets, better jurisdiction of assets, a bigger, more diversified portfolio on every level. So I think we're outstanding value today. I think we have demonstrated repeatedly ability to add value. The value that we have built in the company, starting at 27 cents effectively Canadian in our first fundraise, the value that we have built hasn't been one fortunate acquisition. It has been a succession of good value acquisitions. So we didn't get lucky once and strike it rich. We made a repeated good quality acquisitions. And to do that, we had to say no to 98 of every 100 opportunities we saw. And as we get bigger, our cost of capital comes down, our portfolio is bigger. We can actually, some of those opportunities were good opportunities in and of themselves. They just didn't fit us at the time. So it gives us a really, as you get bigger, some of those come back. They don't go away. They're still there, and they're good opportunities for us just in the future.
Okay, thanks, Fred.
On the capital structure here, I think if you look on the breakdown of our shareholder base there, you'll see that our biggest shareholder alongside South32 with 19% are the directors and management with about 16% of the company. And I think one of the benefits of the approach that we've taken of really focusing on high quality cash flowing royalties is we've been able to limit the dilution as we grow. And two really good examples of that, when we bought the 2 royalties from Yamana, we actually took out a loan when we were private, and we used some of the revenue from that royalty to pay down the credit facility. And so we took out a $4.5 million loan, and then we did a $4 million fundraise and used some of the cash flow to reduce it. And the South32 acquisition that we just did, I think will be a very similar story where we borrowed 25 million and actually 10 million revenue next year, we can start to use our revenue to reduce that debt facility. And that is a very good use of capital for us, being able to do that. And it's something that I don't think I know that no other sub $500 million royalty company can do. There is no other royalty company that can access credit facilities, not with the bigger banks, but even with the sort of more expensive lenders. And that's something that we have in our back pocket that we can look at going forwards. And I think it's why we have such a good advantage in being able to grow the portfolio, because we have access to credit facilities that other people just can't do. And when we were private, one of the biggest constraints we had was that vendors and royalty owners wanted certainty on a transaction. And if we came to them and said, we'll buy this royalty for $10 million, their first question was, do you have $10 million? And if we can, very similar again to the South32 deal, very similar again to the Wang Yong deal, show them that we can access credit facilities and we are not completely dependent on the market, it gives vendors an awful lot of comfort. And that's a really important point for how you close transactions and how you not only you find the opportunity, but once you find it, how do you successfully execute on it? So it's a really important component. After South32 and directors and management, we have Deutsche Balaton, Euro Pacific, and Tembo, who have about 25% between them. And then about 12% is held by a number of private investors, probably about 10 or so, and one or two other smaller institutional investors. So about 30% of the company is free float with retail investors. In terms of our capital structure, we have about 69 million shares outstanding. And I think one point that we always notice that we have never issued a warrant in the history of the company. So there are only there's options and performance rights, but those are only to management. So we've only ever issued equity, for shares directly, and we're covered at the moment by Canaccord and Hayward, who were both in our listing team, and then Roth out of the US initiated coverage on us earlier this year after the South32 transaction.
It's interesting. You guys really have stood apart in terms of keeping that share structure really tight too, because we have seen a lot of royalty companies acquire royalties for shares, and that can really start to bleed your share count higher. You guys have used cash and have used more of a financial strategy, so that is a bit unique for Elemental.
I think one of the really important points touched on earlier is it's the approach we're taking in terms of high quality existing operating assets, and limiting the dilution. That also works really well because we've got a very strong technical core to the team. Richard, who I worked with going back to 2010, Richard had a 20-year career at Western Mining before BHP took it over, and Peter, who's still a director, had a 30-year career as head of geophysics at Western Mining. And so it was Peter and Richard who started Elemental with me. And to have people in the core, in the DNA of the company, who have a career in mining, a career on the technical side behind them, I think is also a bit of a differentiator between most royalty companies, especially most of the junior royalty companies. And I think that technical side to the company has only been strengthened since we joined Discovery Group. And it's really important because so far, I would say our royalties have delivered a lot of value for us. And part of the way that's happened, and I think at the end of this year, we'll see that even more. But part of the way it's happened is because we have a really strong technical review on these. And that probably brings us a little bit onto this slide where I can touch on one or two of the value drivers on some of these royalties over the coming 6 months. And to start with Endeavour's Wahgnion in the center of the map there, that royalty is Endeavour now a top 10 gold miner globally, and they have the second highest exploration budget in their portfolio on that Wahgnion royalty, despite the fact it has a approximate 10-year mine life already. And so I think as this year goes by, we will start to see where the value really comes on royalties, which is where the operator adds ounces and extends the mine life. And all of a sudden, a royalty that we bought for 12.5 million, which is now worth, call it 18 million, suddenly becomes worth 24 million, having repaid us 5 million along the time. And our view is that the Karlawinda royalty is similar. It's a brand new mine, and it's Australia's newest gold mine. And one of the things you see with assets like Wahgnion and like Karlawinda is they have explored and delineated enough ounces to build the mine, which is typically 10-year mine life and access to credit facilities. But beyond that, there's a huge amount of exploration still to come. These are not mines that have been operating for 40 years and they're extending it 1 year at a time. These are assets at the very start of their mines, at the start of their lives, sorry. And that is a really important point, I think, to pull out on here. And it's not just Wahgnion, Karlawinda, they actually have set a resource and reserve update again in the second half of this year. So expect that to be pretty positive. We've had 1 or 2 updates we've put out in the first half of the year from Austral Gold's and KER in Chile, where they had some really good exploration success in the first half of this year. And then I think Equinox at Mercedes mine, they recently acquired that when they bought Premier Gold, and they're going to be updating the mine plan again over the coming quarters. So you start to see a pattern, which is when you buy existing operating assets, they are so invested in continuing and extending the mine life because they've invested the capital. They have got over the biggest hurdle in mining, which is always, can you build the mine? And they're now at the stage where every ounce they find has a really good payback for them. And so for us to have royalties on de-risked operating assets and diversified, as you can see here, by country and by operator, it puts us in a unique position. There is not another royalty company smaller than $500 million that can offer you anything like this. And Elemental today sits at approximately 100 million Canadian market cap. And I think is one of the reasons why, for us, we see that 1 or 2 more really good acquisitions over the next year can actually have a really really strong impact on our share price. And that's before you even take into account Karlawinda declaring commercial production or refinancing of the credit facilities. Even before that, it is a really big difference. So you touched on earlier, I think, Corey, it's one or two of the assets, and the two ones we highlight here are Wang Yon and Karlawinda. And I'll start with Wang Yon, which we bought at the beginning of 2020. Mine had only just been built end of 2019, and this mine had 130 roughly 1,000 ounce a year gold production target, and in their first year last year they actually did 175,000 ounces. Now, I don't know how experienced everyone on the call is in the mining space, but to have a mine come in on time, under budget, and then not just hit its targets in the first year, but actually go 20% over its production target is, it is very, very rare. And one of the things that we have seen is that when you get good quality management teams and good quality assets, they are often the ones that outperform. And the really good assets in the mining world are often the ones that deliver far disproportionate value to shareholders and investors. And for us, Karlawinda, it's an asset in a management team that's much better known in Australia than it is in Canada and North America. But the management team at Karlawinda, we see as a top-rated management team. They've built two mining companies really from scratch into plus billion-dollar mining companies. Capricorn is going to be the next one, and Karlawinda is a cornerstone asset for them. And so we see there's a lot of potential here for not just exploration upside, but they brought this mine in and had first gold pour on time, on budget, again, which already sets them apart, especially in a COVID world in Western Australia. So I think for us, we look at these and see them as long life cornerstone assets for Elemental, going many years into the future.
Now, Fred, are any of these capped? Do any of these have any expiration periods? Give us some more information here, please.
So the Wang Yon royalty it's about 1,000 square kilometer license package, and the royalty covers the whole thing, and it is a 1% royalty, is uncapped, so there is no cap on it. The Karlawinda royalty is about I think it's 150 square kilometer license, and it covers the entire existing reserve and resource. And again, there is no cap on that royalty there. There is a clause on the Karlawinda royalty that in theory, if they more than doubled the resource to over 5 million ounces, BHP, so the world's biggest mining company, could buy back into the mine, and then they could cancel the royalty. But they have to do that at 3 times the price of all investment to date. So essentially, that's not going to, it's not a realistic option. It was originally put in as an option more than a decade ago when they made the discovery and they wanted a right to back in, in the first year or two, if it was an over 5 million ounce, world-class mine. So essentially that royalty is exactly the same. And it's been really important for us as we've gone that, similar on Mercedes and similar on Amankaya, both of these royalties are, uncapped on future exploration success. And Amankaya, that is a 2.25% NSR, so it's our highest by percentage exposure. Every ounce they discover there adds the most value to us. And then at Mercedes, it's our second biggest license, and that is similar in some ways to Wang Yon. It's about a 700 square kilometer license package. And I think for us, really important at Mercedes is seeing Equinox come in as the operator. That asset has a lot of exploration ahead of it. And if you have a multi-billion-dollar operator, they have the ability, financial ability and technical ability to really invest in the asset and get the most out of it. And so for us, having Equinox take over earlier this year is a real positive before it starts to pay us from the middle of next year. And I might just, on that point, jump down to this slide. when you talk about capped royalties and when you talk about upside. And one of the things that we've said repeatedly is that we're not looking to buy a royalty that is capped after 2 years, and we're not looking to buy a royalty unless it is a true royalty. Because if you have a royalty that pays you for $2 million, it's almost a financial instrument. Value in royalties comes from the long-term expiration, and it comes from us sitting here on a call in 10 years' time and Wang Yon and Mercedes having the same mine lives that they do today. That's where the value really comes from. And us being able in the meantime to reinvest that royalty revenue into buying other assets with the same potential. And when you look at a company, take a Sandstorm, multi-billion-dollar royalty company, and I think at Beaver Creek 2 years ago, when we could all still go in person, they gave a presentation that spoke to the fact that they had 3 district-scale royalties as a multi-billion-dollar royalty company, having been around for 11 years. And that was 500 square kilometers and above. And we are starting our lives as a $100 million royalty company with 2 genuinely district-scale royalties with multi-billion-dollar mining companies operating them. And that is something that no other sub $500 million royalty company can ever demonstrate. It just doesn't happen. And it's one of the reasons why I think there is so much latent value in our portfolio. If you discover 100,000 ounces in an exploration project, that value might not be realized for years, or in some cases decades to come. If you discover 100,000 ounces in an existing mine, there is a very high chance that will be going into the mine plan, because they have the operation, they have the infrastructure up and running. And then just this slide here, I think it's our only really material development royalty that we have in the portfolio. So 80% of the portfolio with Karlawinda coming on stream is producing assets, and Laverton is our largest non-producing asset. And it's a really interesting one. We sort of split it into 2 sections, which is a near-term oxide resource, shallow in Western Australia. The operator has the Barnacote mill, which operated in the early 2010s. And they also, in the past, they trucked some of the resource to one of the nearby operators, and there's 2, Dacian Gold and I think Anglo Gold, might be Goldfields just to the west. But the other part that's really interesting at Laverton for us is Lancefield. And this was in the mid-90s in Western Australia, one of the top 10 underground mines. And this asset has had no exploration since the mid-1990s. And that is incredibly unusual in Western Australia. In this case, it's partly a function of multiple operators and owners. And like some of the gold belts in Western Australia, there's been a succession of different junior, mid-tier operators and owners. And so some of these assets have passed through different hands, but each time never really being developed. And so for us, we see that as one of the sort of sleeper, something that could be really, really material in value. And if you look at what they mined to in the past and what they had delineated at $300-500 gold prices in the mid-1990s, there is huge exploration potential there today for someone to go and take the value out of that. And I think for us, we see that we have got in there early before a new operator comes in, before someone really develops that and starts to add ounces. And I think in the future, that will be a material asset for us going forwards, let alone the oxides, which are more in the short term.
Okay.
So a few things here we've touched on over the course of this, uncapped nature of the royalties, the fact that there is no buyback to the operator. We have exposure to new discoveries, but we have exposure to new discoveries, on a de-risked asset that is already up and running. It's done the hardest part. And these are royalties that are operated by larger companies, so they have the best potential to unlock that value for us. And there's a quote there that it was probably one of the first quotes we had when we started Elemental, from Pierre Lassonde, who founded Franco. And it's one of the most important points to understand on the royalty model, is that optionality you get on future discoveries and exposure. And it segues neatly into our point on some of the royalties we have that aren't square kilometer license packages. They are very large in size and scale. This is a bit of a breakdown in terms of some of the operators and in terms of the portfolio by NAV. And you can see that Karlawinda, that just had its first gold pour, that is almost 50% of our NAV. So that asset coming on stream, in this quarter, and getting, I think we'll have updates in the coming weeks on it. That asset is one of the major drivers for us in terms of value, going forwards.
Okay. Everyone keep sending in your questions. We had a couple more questions that came in, but we have already covered it, that renegotiating of the Sprott loan. We talked about that earlier, and also the expectations on dividends. So those were covered already earlier, so you can recap those answers on the recording. But again, any more questions, guys, please send those in.
And this is, I think this is one of the key points here, is that it's always quite hard to put a value on net asset value. For royalty companies, there's a lot of intangibles, and it depends really on the assumptions you put in. But on a price to revenue basis, which is the most transparent way of valuing it and looking at cash flow, even if you put us among some of the bigger royalty companies, we comp really, really well. And one of the names on this chart, Ele Gold Royalties, is a good example, because in the last month, Ele were taken over by Gold Royalty Corp for 300 million Canadian dollar valuation. And I think we would have this year more than double the revenue that Ele had in their portfolio. And we're currently at 100 million Canadian valuation. So it gives you an idea that in the royalty space, the most value is put on quality assets and on cash flowing assets. And our portfolio is a really, really good combination of quality and cash flowing royalties, which is what differentiates us. And it's also what means that we will hold the most value.
So Fred, this ties into a bigger discussion here, and we're going to wrap up this webinar soon, but there are a lot of royalty companies in that recent deal with Ele and Gold Royalties. That's a maybe trend that a lot of people are looking for here, a bit of a consolidation of some of these, let's say sub $500 million market cap royalty companies. Is Elemental, are you guys going to be an acquirer? Do you think that we will see more consolidation here? What are some of your insights on that general royalty space now in terms of smaller cap companies?
Well, it's the biggest difference between most of the royalty companies in the sub $500 million space is that most of them are weighted towards exploration and development assets, and really the big differentiator with Elemental is the maturity of our assets and the quality of them. So I think that whenever there is consolidation in the industry, people are looking for assets that will add value to them. And if you're a $500 million, $2 billion royalty company, you are going to be far more attracted to high quality producing assets than you are to exploration and development royalties that you can go out and buy yourself. And I think that if you look at Ele, they had, after us, they had the highest revenue in the sub $500 million royalty space. And they also had some good quality assets in there. So I think that's probably the reason why that a deal was done with them. And I think that looking at it from the outside, clearly our royalty is an attractive one in terms of the assets and in terms of the makeup of it. But from wearing an Elemental hat, we have been listed not quite a year to date. I think it actually, I wasn't aware, but I think it actually might be a year tomorrow. So our 1-year anniversary as a listed company tomorrow, but with our biggest asset just about to come on stream now. And it's absolutely not reflected in our valuation. And so for us, I think we would want to see some recognition for the value that is built into our portfolio, but maybe not reflected in our share price, number one. And secondly, also where we are at a 100 million market cap, we can add a lot of value through one or two smart deals. When you're a $500 billion market cap, and part of the reason they're looking at M&A is because it gets harder and harder to add the same value. There aren't that many $200 million deals floating about, whereas you can buy another royalty company with a diversified portfolio of producing royalties for 200 million. Well, that sounds fantastic. So I think that's part of the driver of it, and I do think you're right. There will be some more consolidation in the industry, but the best thing we can do is continue to focus on building the value in our portfolio. And if it's not reflected in the market today, I think it will be increasingly obvious as we tick off some of those boxes that we went through in the slide, because it will be a really clear differentiator. If you look at our revenue now has not really changed since December last year. But if you look at our Q3 revenue, once that comes in, if you look at our Q4 revenue, once that comes in, all of a sudden, it's going to be almost double just on the basis of what we own. And if we do another acquisition in Q3 or Q4 on a producing asset, that gives us an opportunity to I think hit the target of doubling revenue year on year, which is something we have done every year to date. And I think at that point, especially with a refinancing of the Sprott loan and cutting our cost of capital and cost of the loan in half, it's one of those, I think, almost inflection points where suddenly people wake up to it and go, my goodness, Elemental's quietly been going along unnoticed under the radar in the background, but has built up a really high quality portfolio, and they're actually starting to tick some of the boxes that mid-tier royalty companies tick, but they're 100 mil market cap. And I think that's probably the point where if we were going to talk to people about M&A, I think that's probably getting to the point where we could get the most value for our shareholders.
Okay. Hey, Fred, there's a lot there to unpack, but really what it comes down to is a lot of growth in the near term coming from existing royalties within the company. We're going to wrap it up here, Fred. Take us to maybe the last slide here, and then we'll put this away.
So I suppose this one is just, it's difficult to highlight it in some ways, but this is a kind of indication of where our revenue has gone and where our share price has gone, and the obvious disparity split between them. And so in the background, our share price has essentially been treading water for the last 3 months, but our biggest asset is in the process of de-risking itself and coming on stream. And I think that it puts us in a position on this final slide here where we're the only emerging royalty company providing material gold revenue. So exposure to gold prices today, we really see that flow through instantly. We are doubling our revenue from 2020 coming into 2022. So that is from our existing assets without taking anything else into account. We are 80% plus weighted towards producing assets. Again, you have to go to the $1 billion plus royalty companies to see that. We have an experienced team in terms of capital markets, in terms of mining, but crucially in terms of royalties as well, and a proven track record since we started in 2017. And these royalties are uncapped in terms of revenue, no buyback options. And when you combine all of those aspects with a small team, you get a really good margins on the revenue that you do receive. And that, I think, is that's some of the summary for investors.
Okay. Hey, Fred, I appreciate your time here. Again, if you have any more questions, anybody has any follow-up questions, you can always email me, fleck@kereport.com, and we'll get Fred to address those on our show. Fred, again, thank you for your time, everybody. Thank you for tuning in, and thank you for all the questions that have come in. Hopefully we address those sufficiently for you. And again, if you want some more details on anything, just email me directly. Fred, thank you again for your time.
Much appreciate it, Corey. And if I could just say as well to listeners, please feel free to reach out to us directly at the company, email us, and happy to answer any questions and get back to you.